Hey, it's James here, and in this video, I'm going to walk through the difference in how your typical retail investor looks at a chart and how a professional trader looks at a chart. So we're actually sitting on the chart of Apple, and what I want to talk about is this gap right back here. So a retail trader sees this gap, maybe they gamble on it, maybe they don't. A professional trader sees the same gap, realizes that it's gapping over resistance, realizes that it did build a nice move here and then consolidate. So there's probably at least a 50% chance this is going to have a measured move. So the professional trader can wait for this to pull back and retest that for an entry, or they can even enter right on the open of this green candle. Let's just say they were more aggressive and entered right on the open. If they think this is going to be a measured move, then they could do something like put trend extensions on it, use this low here, there's the high, there's the pullback, and that points to a target of $297. So if I pull my profit target up to that level, that gives me a roughly $18.80 target per share. If I want a good asymmetric risk, I might go for 2 to 1. So that's going to be 940 ticks. So there's my stop loss. The stop loss is not based on a specific candle structure. It's not based on a specific low. It's not based on any of that, because the reality is it's a myth that some magical candlestick low is going to protect you. You know why it's a myth? Because that's what retail traders are taught. They're taught when they use this specific low or this specific candle that if price goes past that, the trade idea is null and void. And it's complete nonsense, because market makers know where most stops are sitting at. A, because it's the most obvious place in the chart, but B, they can also look at order books and everything else and see where your stop losses are actually pulled at. So there's no reason to think that some magical level is going to protect you. Essentially, all you're doing when you take a trade is you're just trying to give that trade room to breathe. You're essentially trying to avoid being stopped out by random noise. And so I can do something like this and get a 2 to 1. But in my case, a lot of times I go even tighter. I might go for something like this where I'm going to say, you know what, I'll give it $5. If it goes under $5, fine, I'm stopped out, whatever. And then that sets up this exact same trade with this exact same profit target. Suddenly it's a nearly 4 to 1 trade. Or I might simply go into the options and buy a single leg option on this, a call, where my risk is automatically capped. Or I might go into options and sell a vertical spread. For example, if I'm bullish here, I might actually sell a $280 put and then buy a $275 put just in case I'm wrong. And that allows me to collect that premium so long as price goes up. There's lots of different ways to approach it. But again, it's very different from how retail approaches it, because retail is looking for a sure thing. Retail is looking for that. This is almost guaranteed to happen. And professionals know that nothing is guaranteed to happen. And if you got a 50 or even a 55% chance of being right, that's a pretty good trade to take, so long as there's asymmetric reward to risk. So looking more recently at this gap here is the exact same trade. It's just in reverse. Price was moving down on Apple, put in a low, had a pullback, and then gapped under that low. A lot of people will call this a gap and go. So if you put a measured move on there from the high, there's your flagpole, there's your pullback, has a measured move at 273.82. So same deal. If I'm going to short this on the open, and I know my target is 273.82, that gives me 1,358 ticks to target. So I can simply say, hey, I'm going to give this a little bit of room to breathe. There's a 2R trade right there, right? Put a stop loss up there, target down there, done. And in this case, this is unusual, but in this case, this trade would have opened and closed all in the same trade day. There's not going to be a flashing sign that tells you this is the trade that's guaranteed to win. You never know. There's always at least a 50% chance that you're wrong. That's just trading. If you can't handle that, the best thing you can do is simply invest in the major index funds and be a passive investor. If you enjoyed this video, give it a thumbs up, subscribe to the channel. Please remember, I'm some guy sitting in a spare bedroom. Nothing in this video is financial advice. You should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, forex, or any other tradable assets. Thanks for watching. As always, please remember to trade and invest safely.